Okay, so welcome to today's class, and you're going to start with the fundamental analysis. And as you said previously, fundamental analysis, we focus on especially, great, you can hear me, that's very good. We focus on the economic data and the political environment of a country. And we focus mostly on the countries for the major currencies, the 8 major currencies, okay? So fundamental analysis is based on economic data and geopolitical factors. Traders who trade on fundamentals will carry out their analysis based on the data released by a certain economy, which indicates the economic performance of that country. So earlier on, I'd advised you to download a Forex Factory calendar, and it gives you a schedule of what reports are expected this week for the 8 major currencies, right? It also gives us the forecast data, like if it's CPI, that is inflation report. They will show us what was there previously and what is forecasted for this week's report. Then now we wait for the actual. So you're able to tell in advance what is expected. Yeah, then now you can trade on the expectation of the economic data for that country for that week. So fundamental trader will closely monitor economic reports from various countries, and based on his analysis, buy the currency for the growing economy and dispose of currencies for the slowing economies. Here we saw that where economy is doing so well, the reports show the economy is growing, many investors will go for that. So as they buy that currency, as they invest in that country, the currency grows in value. It appreciates, all right? So some of the key reports used in fundamental analysis are inflation, which you'll find it called as CPI, that is Consumer Price Index reports. Those ones, they mean a lot in these countries because those are the reports the central bankers look at before they agree to raise interest rates. If the CPI is high, they will raise the interest rates to curb the amount of money circulating in the country, all right, rather to compare, to try to reduce the money in circulation. If the CPI is going down, they will reduce the interest rate to pump more money. So these countries have targets. Each central bank has a target. Just like in Kenya, if you check the inflation reports, there is a target the CBK should, which now it helps them to make decisions. So if the CPI or inflation has gone up, is past the target, then they need to do something. Yeah, either they raise interest rates or they reduce interest rates, depending on the inflation of the country. They can also do what we call quantitative easing, and you see those are other measures they use, other monetary policy measures they use to reduce the amount of money circulation or pump more money. Yeah, like the use of treasury bills in Kenya. That's why New York tried to also use other monetary policies measures to curb the inflation, or rather the amount of money in circulation. So we look at the CPI report, we also look at employment and unemployment data. And NFP. NFP stands for non-farm payroll. And that's a key report in the Forex market. It's released, that's a US report. It is released every first Friday of the month, usually around 3:30. Okay, the time is always shown. That's the first Friday of the month. We expect NFP to be released, and it's one report is of course the market to move a lot. Yep, especially if it is a bit away from what was forecasted. Maybe they expect like 200 jobs, then 200,000 jobs, then we get something like 300,000. That's a big difference. So we expect the dollar to jump in a way, all right? Then you have the retail sales, the major central bank meetings minutes. Like today, I think the FOMC, that is the Committee for the Fed, the Federal Reserve Bank of America, they should be releasing their minutes for the last meeting day. Yeah, and that is now where you read, as the report is read, now the investors are able to gauge the tone. Yeah, is it hawkish, is it dovish, as we shared in our earlier report in the glossary. Yeah, so during the minutes, when the minutes are released, you find the currency jumping up and down, because as they read a line, they make a decision, they buy, they sell, there's that kind of movement. So many times, me personally, I don't trade such, especially when the minutes are being released, because as they read between the lines, I just prefer to wait until the market comes down, then you enter. after now it is clear whether it is the dollar or whichever currency is going to appreciate or it's going to go down. At least it takes some direction after the minutes have been fully analyzed. We also look at the trade balance, and then the hawkish and dovish central bank member speech. Yeah, we said that. So even in the calendar, you'll always see who is scheduled to speak. Yeah, and depending on the authority of that person or their position, it can either be, you see, if it is red, it means their speech is like to have a very high impact to the market. If it is orange, medium impact. If it is yellow, it is maybe not so much impact, depending. Like if the person giving the speech doesn't have voting rights, then it may not make much sense. It just be like it's a low impact kind of a speech. But it's like the governor or the chair of the committee for the central bank, then it's likely to be. It means their speech makes a lot of sense. It's like not just telling us what the bank is planning to do. Yes, so it actually, you'll find it's actually marked with red. So it means it's very important with a high impact. It will have an high impact to the currency of that country. So fundamental traders will always be on the know of what is in economic calendar and plan ahead. Yeah, so it's always like every Friday. Today, if you open the economic calendar and you look at it, you'll see already we have what is forecasted for tomorrow and Friday. But for next week, you only see one. There's usually three columns. One is the previous reading for that report. The second column is what is forecasted, because the researchers do some research from the big investors and say, what do you expect will be the next reading for, like CPI? So once they collect all this data, they compile and they come with a particular figure, which is what the investors are focusing to be the next reading for CPI. And then when that day comes and the time, the actual is released, right? So like today, if you open for next week, you'll only find what was there last, the previous reading. Then the forecast is blank, and then the actual is blank. Then on Friday, some of them will actually be filled. They will fill out the forecast. Others will be filled on Monday morning, all right? Now that helps you to prepare to know what is expected and how is it likely to affect the particular currency, all right? But not any successful trader should always try and merge both technical analysis and fundamental analysis. And that's what we said. They always speak to each other. They speak the same language, all right? And we saw an example yesterday where the Brexit happening in UK, and also we did our ABCD pattern, and they all spoke the same language. Based on the pound has been going down because of Brexit, but it reached a point, still with all this Brexit noise, it just started shooting up again. And it began to shoot up at our D point, where the technical analysis was telling us to buy. Also, the fundamental now, they indicated now with the Brexit, it is also time to buy. So they speak the same language. You don't have to really be caught up in everything, running with everything. You can still stick to technical analysis, and you still have your fundamental stuff accommodated in the technical analysis, right? So you're going to look at the key reports for each particular country and see what they mean and how they affect the markets. So we have important economic indicators for the major currencies. So I will not read everything because it's just theory. You can just read at your own time. I'll only try to elaborate on some of them, but just at your own time, just read. It will also be good for you to refer to it. When you look at your economic calendar and you see the scheduled reports, and some are in red, and you're not sure what they mean, you can always refer to this document and see, so what does that report mean? And what kind of impact is it likely to have in that particular currency? So for USD, we start with non-farm employment change, the NFP, which you said is released every first Friday of the month, all right? And that will have a very big impact, all right? So depending, if it's negative, it means the dollar will go down. If it's positive, the dollar will go up, right? So it's released every first Friday of the month. That one every forex trader knows, even without looking at the calendar, that is standard, right? Then we have the GDP, the gross domestic product. We have the retail sales, consumer price index, the CPI. CPI is also a very key report across all the 8 major currencies. Yeah, it means a lot because that is one of the key indicators, the key reports the central bankers used to make their decisions on monetary policies, was to change whether to tighten or to loosen the monetary policy. Then we have personal consumption expenditure. Then University of Michigan consumer sentiment. Yeah, consumer sentiment will mean a lot, and it can also make some movements. Then we have the euro. Again, as I said, euro is used by 27 countries. So any of these parameters, if they're happening in any of those countries, they are going to affect the euro. So it's always good to know which countries use euro. So they have always said, I'll send the report and I have to send it today after the class. I will send you a document with all the 27 countries which use euro so that you're aware. If it's Italy, what is happening in Italy? Yeah. So if there are political issues in Italy, it's going to affect euro. If there are political issues in Germany, it's going to affect euro. France, euro, and all those Greece. So it's good to know which countries affect, so they use euro so that if there's anything happening there, whether economic or geopolitical, you know the impact it's likely to have in euro, and it can help you make decisions whether to buy or to sell euro or to stay away from it altogether. All right. So we have the GDP, employment change, German industrial production, German in favor business climate survey. So this, just read at your own time the notes. Yeah, you don't need to read word by word. It's not really, because it's just a write-up. Then the budget deficits and consumer price index, the CPI, just like we saw in US, right? Then we go to the next one. That is the GBP. And we start with the CPI, right? That means a lot also in UK. The BOE looks at this account as a measure of inflation. It means the change in prices of consumer goods. Like the last time they raised their rates was last year. But before then, for many years, the Bank of England had never raised for many years. So what happened because of Brexit? The pound had become so cheap, it had really lost value, and that now caused the inflation to go up. Now it has reached the point of 2.9, which was extremely beyond their target. Their target, I think, it's 2. All right. So at 2.9, the Bank of England had to take some action. So slowly by slowly, as the CPI is going up, you see the more investors buying the pound because they know these people are likely to raise the interest rate. Yeah. But the moment they raise the interest rates, the speculators now they start disposing of the pound because already it has been achieved what they were expecting. All right. So you have to monitor the CPI reports. Yeah. Every month as it is released, is it going up? Is it going down? And what is expected of the bank, the central bank to action as far as the reading of that CPI report is concerned. All right. Then we have the unemployment rate, the GDP, purchasing managers index, GFK consumer confidence report. Just some of them are still similar to what we've seen in Europe and US. Then you have the JPY in Japan. So in Japan, we look at the GDP, also what they call the Tankan surveys. Yeah, you can read that to understand how it's measured. Then trade balance, unemployment rate. So unemployment and employment rates, they weigh the same across the 8 major countries. Those are key reports in those countries. Okay. Then consumer price index, just as you've seen in the rest, and then the core machinery orders. All right. Then you look at the Canada CAD. Again, consumer price index is the same across the board. GDP, trade balance, IV purchasing manager. So it's just few reports which differ, but some are just the same, like the trade balance, GDP, CPI, unemployment, and employment rate. That's one. They have almost the same level of importance across the 8 major currencies. Then there are just a few ones which are unique to a particular currency, right? Then the price of oil. And you see, historically, the price of oil has been highly correlated with the USD CAD. The general rule is that whenever oil prices start climbing, the CAD usually follows. If the price of oil is projected to increase over the next couple of years, then you'd want to go sell the USD CAD. So when the price of oil goes up, the CAD strengthens because they export a lot of oil, right? So when the price goes up, it strengthens. So the USD CAD will go down because it means you require less CAD to buy 1 unit of USD, because in this case, CAD is a quoted currency, right? So when the oil is going up, CAD will strengthen. When the oil price is going down, then CAD is likely to go up. So when there are those oil crises, try to look at what is happening to the CAD. And you're going to see that under the currency commodity correlation. Then we look at AUD, Australian dollar. Again, CPI, it plays the same role across the major currencies. Balance of trade, gross domestic product, that's a GDP, unemployment rate. Then there we have, I'm called a commodity dollar for a reason. Yeah, so one important characteristic of the AUD is that it has a high positive correlation with gold prices. The reason behind this is that Australia is the third biggest gold producer in the world. As a result, whenever the price of gold rises or falls, the AUD goes along for the ride. So they are correlated, strongly correlated. To mean the gold is going up, AUD is also appreciating. If gold is going down, AUD is also losing value. It depreciates. All right, and you also see that under commodity correlation, currency commodity correlation. Then we have the New Zealand dollar. So the major reports are the GDP, CPI, and the balance of trade. Okay. Again, you said you don't need to read through at your own time. Just read because they're just notes. You read through, and then I'm just going to take you after this to take you to the calendar. We see how we interpret the reports in the calendar. CHF, GDP, retail sales, CPI, balance of trade, still the same. But also, although the Swiss, they don't produce gold, but there's a correlation between the CHF and gold, okay? So you see, not only do the Swiss refuse to join the coal kids, in quotes, of the EU, but they are also the only country that still adheres to a gold standard. About 25% of the country's money is backed with gold reserves, giving the CHF an 80% correlation with price of gold. This means that whenever the price of gold rises, the CHF could stand to benefit as well. So they are also correlated because of 25% of the country's money it's backed with gold reserves. So that means they are related. It's like now when the gold is raising value, what the reserves also raising gaining value. So the CHF becomes, or it also raises the demand for CHF goes up. So as mentioned earlier, the CHF has an 80% correlation with the price of gold, as 25% of the Switzerland's cash is backed with gold reserves. When gold prices go up, the CHF usually goes up as well. Conversely, when gold prices slide, the CHF likewise declines. All right? Great. So that's it about the reports. At one time, just read because they are just notes. But now I'll take you to the calendar. We see how to analyze it and how to interpret the economic calendar. So I'll share the screen so that you can see. Kara, I've seen your question. I will respond to you. I'm just ready to talk to my phone, but I'm just seeing your query. I reply to you later. Let me log in so that I'm sure those who are using phone, they can see the same screen like the rest of us. You can see that. You can see the Forex Factory calendar. And it takes a while to pop up on phone, because I just give it time for people who are using phones to be able to see the screen. So as you see on that report, we'll start from the date. Today's date is Wednesday, February 20th. Then the time the report is released, all right? So when you download the calendar, ensure you change the timings, the settings to match the local timings in Nairobi, so that there is no confusion, all right? So ensure you change the settings to the local ones on the time, so that you don't get confused. So mine, when you look at it, this is the South African times. I've already now changed my settings to that. Then we have the currency, and then the impact the report is going to have. If it's yellow, it means it's a low impact report. If it's red, it's high impact report. But if it's just medium, it's orange. Today we didn't have an orange report, okay? Then when we look at in between, there is where we have the detail, there should be something like a folder. So if you want to know the impact that report is going to have on the currency, you open the details. You just click on the folder and then it opens, all right? I want to open the one for, as we say today at around 9, that is 10 p.m. Kenyan time, the FOMC, that is the Committee for Federal Reserve Bank of America, are going to release a meeting, the minutes for the last month's meeting. And in that meeting, they raised the interest rates. So in the today's minutes, the investors want to see what is the plan going forward. When are they again likely to raise the interest rates as per whatever they discussed during that meeting? So if you're able to watch the USD at around 10 p.m. Kenyan, you'll see a lot of movements up and down, because as they read the minutes, they also interpret differently. So some are buying, some are selling. So I just prefer to stay out, especially during the minutes or during speeches, because also in a speech, the person giving the speech might say a word, it tells them to buy, they buy. So it's a lot of like whipsawing, up and down without any direction. So I prefer to wait. They read their minutes, they make the decision now. When there is calmness and the currency takes a particular direction, I can actually come in. All right, so just give it time to calm down. All right, so for FOMC, if you open the folder, it tells us more hawkish than expected is good for currency. Remember, we discussed about the hawkish tone and dovish tone under the glossary. So if the minutes are more hawkish, then it's good for currency. To mean the dollar is likely to strengthen. It is scheduled 8 times per year, 3 weeks after the federal funds rate is announced. All right. So it's actually 3 weeks after they raise the interest rate. So now they release the minutes of what was discussed in the meeting where they agreed to raise the interest rate. So to know that understand the details of the report, you can always open the detail and it will tell you what that it's all about. We look at the wage price index. You just open it, tells you change in the price businesses and the government pay for labor, excluding bonuses. If actually is greater than forecast, it's good for currency. It's released quarterly, about 5 days after the quarter ends. All right. So that's the details. Then we have at the extreme right, we have the previous, forecast, and actual. So the previous, it means it is the last reading. The last time it was reported, what was the actual that time is the one previous today. Then the forecast, as we say, the researchers do some survey from the investors and see, so what do you predict? Yeah, what's your forecast concerning the next reading for, if it's a CPI or employment or unemployment, okay? So the forecast always filled just before the week starts. So they fill the forecast, but we'll always have the previous, as long as it's already now, it has gone a cycle for that report, okay? One cycle, so we'll always have the previous. Then once they do the survey, they give us the forecast, all right? So it is the forecast which now makes the investor to start planning to trade that. Like CPI, let's say CPI for UK was 2.2, and then we see the forecast is 2.7. Even before the actual is released, you see the pound starting to appreciate because they work on the forecast, yeah? So if the actual is greater than forecasted, depending on the report, Yeah, like if it's CPI, we use the same case for today. Let's say the previous was 2.2, forecast is 2.7, and then the actual becomes 2.9. The pound just shoots and shoots. Yeah, because it's like now they're almost guaranteed now. The next meeting, they're going to raise the interest rates. So the moment the forecast is, if the forecast column is filled, the investors start now planning and trading as per the forecast report. All right. And now that's what we are saying. As they start trading on that, the charts also start to communicate. The technical analysis starts now communicating, and as per whatever the fundamentalists are acting as they act on the reports already they are waiting to be released. So you just find the two analyses just speaking the same language at the end of the day. All right. So you see, so when the actual is worse than expected, it's usually in red. All right. You can see the actual column that's been filled today. The reports have been released. So if it is worse than expected, it is red. Yeah, it means now it worked against the currency. If it is better than expected, it is green. All right, that's why you see some are green, some are red. But if it's just the same, or just in the same range of the forecast, like just the same reading, then it remain black. Right? So that's the interpretation of the colors under the actual. So today is Wednesday. We'll see tomorrow. As you can see, for tomorrow's report, you just click the arrow to take just for the next day to see what is expected for tomorrow. So you can see tomorrow it's a full day in the economic calendar. All right. So you see, previous is already filled, forecast already filled. We're only waiting for the actual will be filled at the time the report is being released. So once it is released, the actual is filled, and then now the market will respond to the report as expected. You can see like Europe, we have so many reports tomorrow being released. All right. So if we go to next week. Next week is on Monday. Let's start from Monday. As you can see on Monday, our forecast is blank, actual is blank. But on Friday evening, they will start filling the forecast for the whole week. If they don't fill on Friday, they fill on Monday, right? So if you're a fundamental analyst, you want to see by Friday, you want to see what is planned for next week. Then you start planning how you're going to trade next week, that particular currency, okay? So the whole of next week is blank, but they start filling the forecast on Friday and Monday. Okay, some which are already like the building permits and starts, but the rest are blank, okay, as you can see. But now come Friday, Monday, they fill the forecast, then now they wait for the actual report, and then the market will respond, all right? So other than the reports, in the Forex Factory calendar, you also get the news, all right? They always give us the latest news here. So in time, we just come and refresh. You can see what is up, like Berlin, UK Foreign Secretary Hans says German Foreign Minister, entire Greek, blah, blah, blah. It's a long story there. So you can always see the latest news here, Brexit or whatever it is. Yeah, like the time there were issues between North Korea and Trump when they were testing those ballistic missiles. You could just, especially on Fridays, you see just the gold starts rising and rising, and then you're like, what has happened? You come here, you see that Kim has said is going to test stronger ballistic missiles to America and blah, blah. So that already scares the market. It scares the market, and gold is a risk haven. So when there's a risk in the market, many investors will run to gold, because gold, its intrinsic value does not change, does not depend on any country's economy, does not depend on anything. So when there is any risk, so everybody will run to the safe havens. Yeah. So gold and Japanese yen are the safe havens. Yeah. When investment, there is a risk, there is any scare in the market, they run to gold. So gold appreciates. So sometimes you see Friday around 2, 3, gold starts rising up. Then you come in, you see now they have already reported the news about the guy saying is going to test stronger missiles. So you also go in and you buy also. You can see there's already report and people acting on it. You act on it also, okay? So even to see the latest news, the Forex Factory will always give us the news around here. Brexit news, you'll always find them here, and everything else is current. They also have the hottest stories here. Brexit Accord is already being hammered out. That was released 45 minutes ago. Yeah, so you can always see so many news here. If you want to know what's happening in the market, or rather the news affecting the market. Great. That's it about the economic calendar, how to interpret it and how to use it to make your trade decisions. if you want to. But it's always good, even if you're a technical analyst, it's important to check what happened in the fundamental side, the economic report. Just have an idea what is happening. Because some reports may actually choose to stay away. All right. The others were like, okay, it doesn't matter. I'll play out as long as my technical analysis tells me this, I'm gonna trade this way. But there are some like, I just have to stay away. All right. So always try to just have a glance at the economic calendar. You can check in the morning, see what is scheduled in the day and what time is going to be released. Then now you plan how you're going to trade. Great. So that's it, unless there's some question about the economic reports. We will end there. Then we go to currency commodity correlation. Is that question? I'm seeing a number of chats. All right. So just my phone had not yet updated. So we go to currency commodity correlation. So we say there are some currencies which are strongly related or correlated to certain commodities. So whatever is happening to that commodity can help us decide whether to trade that currency, whether to sell or to buy. All right. So we're going to see which currencies are those and how they are related. So we see it is widely known that economic growth and exports are directly related to a country's domestic industry. So it is natural for some currencies to be heavily correlated with commodity prices. So the three currencies with the tightest correlations to commodities are the AUD, CAD, and NZD. Actually, we've already seen all that. We just go through by mentioning through just roughly as because we've already actually discussed it under the economic indicators of each particular country. But other currencies that are also impacted by commodity prices but have a weaker correlation are the CHF and JPY, all right? So knowing which currency is correlated to which commodity can help traders recognize and predict market movements. Here we will look at currencies correlated with oil and gold and show how you can use this information in your trading. Like oil and the Canadian dollar, we already said that when oil is going up, we expect the dollar, the CAD to strengthen to go up. So there is also another report which is released by US, but it affects the CAD, and it's called the energy. Sorry, it's about the gas. I think I'll show you that. You find that report, although it's for US, it affects the Canadian dollar because it targets on the oil consumption in US and also gas consumption, which they get from Canada. So there's also that report about the gas and the oil, also released by US, because they import those ones from the Canada. And you see, a drop in oil prices is every oil producer's nightmare, while oil consumers enjoy the benefits of greater purchasing power. All right. So it's always good to also, OPEC is that organization which for the oil producers. If they are planning to cut oil production, or do we expect the oil price will go up? Then now the CAD will go up. So any news about oil, it's going to affect the CAD, whether cut in production, increase in production, prices going up, prices going down, and any other crisis in Middle East will also see less oil in the market, so price will go up because there is less supply but more demand, prices will actually go up. All right. So even when the local regulatory is called the ERC, the ones who regulate the oil, who always release the fuel prices every mid-month. So when you see them raising the prices for the oil in Kenya, just ask yourself, so what is happening in the global? We hear them say because the price of a barrel has gone up, so means that CAD is also going up. All those even local news that they can also help you to know how am I going to trade the CAD, or you can also trade the crude oil itself. It's also a commodity you can actually trade, all right? So based on all those news. So that's oil and CAD. Oil goes up, CAD goes up. Oil goes down, CAD goes down. All right, and you can see a chart there showing us how they are related. Sorry, not that one. I went to the wrong chart. And you can see this is oil in red. It goes up, the pair goes up like that. Yeah? Then we have the oil and the Japanese yen. Japan imports almost all of its oil compared to the US, which imports approximately 50%. So Japan's lack of domestic source of energy and its need to import vast amounts of crude oil, natural gas, and other energy resources make it particularly susceptible to change in oil prices, okay? So because, remember, Japan is a highly manufacturing country. They depend on exports, but they need oil and gas to manufacture those goods, and they have to import the oil and gas. So because of that, when prices go up, it affects the economy. So JPY is likely to be affected negatively. So it means like if the oil price is going it's going up in prices, you expect the CAD to appreciate and the JPY relative to CAD to go down. So in such cases, the best pair to target is CAD JPY when there are oil issues, right? Because you know the JPY is affected negatively and CAD is affected positively because the prices are going up. So in such a case, you like to net more pips than if you just target like USD CAD. So you have to check which is the best pair to trade depending on the particular news in the market or depending on this kind of analysis, all right? So JPY gets affected negative if the price of oil are high, if there are oil crises. But if the price goes down, JPY now it benefits because they can afford oil at fair prices, okay? So that's basically what it means. Then we go to gold, going for gold, and it says that trading the Australian dollar is just like trading gold in many ways. Australia is the world's third largest producer of gold, and the Australian dollar had an 84% positive correlation with the precious metal between 1999 and 2008. This means that when gold prices rise, the AUD appreciates as well, all right? So as we conclude, we are saying, if you want to trade commodity currencies, the greatest way to use commodity prices in your trading is to always keep one eye on movements in the oil or gold market and the other on the currency market to see how quickly it responds. Due to the slightly delayed impact of this movement on the currency market, there is generally an opportunity to overlay a broader movement that is happening in the commodity market to that of the currency market. Bottom line, it never hurts to be informed about commodity prices and how they drive currency movements. So we are saying, when you see gold going up, it means AUD is following, but it responds slowly. So if you see gold going up, you can actually go and buy the CAD and the AUD and you hold because it's going to respond. But slowly by slowly, it rides on the appreciating gold. Same case with oil. Oil is going up, CAD with time is going to respond and start also going up, all right? So that's it about currency commodity correlation. At your own time, you can read deeper and try to also compare in your charts. Open one chart for USD, ZAU USD, that is the gold, and USD CAD, and see how they are related, how they are moving. Is it USD CAD? No, USD AUD. And then for crude oil and USD CAD to see how they are related. You can actually see them in the chart and you make out your conclusions. Great. So we are going now to, we'll go to the last part for today, and that is the indicators. So we said also we'll focus more on price action. It's also good to know some of the commonly used indicators because you will read some analysis. They say now the MA50 has gone above the MA200 and we need to see this, what's likely to happen. Then you're asking yourself, what are these MS they're talking about? So it's also very good to have this information as you come across analysis. Also, you can also try to use it to merge it with your trading. You don't have to stick to one strategy. You can always even refine it, make it better for yourself, yeah, by using all the knowledge you have. Okay, so I don't have to limit you to just what I use. It's good to give you all this information. At the end of the day, you see, so what works best for me? How can I use this information to refine my strategy to work even much far better for me? All right, so although we are not using the indicators in our analysis, in our strategy, it's always good to know the commonly used indicators and how they are used and how to interpret them. Okay, and you're going to start with the moving averages. This is highly used almost in every, when you open, like there are these guys called they call themselves what? They send emails almost every day, yeah? So I subscribe to them. And you see something like the MA50 has crossed above the MA200, so we expect things to go this way, all right? So you might sit and then you ask yourself, so what are all these MS? It just helps you to know what they're talking about and what is expected when such occurrence happens. Although you don't have to rely on their analysis, it's always good to know, to have the same information the others have in the market and know what is happening. Also get to understand what people are talking about as they talk about MS and all these other indicators. So we are saying a moving average is the average price of a security over a set period of time. The commonly used MS are simple moving average, that is SMA. Just a second. It's okay. I thought I had actually, I'm seeing some errors I thought I'd already rectified, but I don't know how come they are still appearing here. Like SMA should be with a close, not zero, but should be a closing bracket, and exponential moving average, EMA. So we have the simple moving average, SMA, and there's also linear exponential, but the exponential moving average it's actually the one which is much far better than linear moving average. So they mostly use the simple moving average and the exponential moving average. So SMA, it simply takes the sum of the past closing prices over the time period and divides the result by the number of prices used in the calculation. Like when you hear SMA 50, it means they have just used the closing price for the last 50 days and then they averaged by 50. So they add all of them. They take the last 50 days, take the closing prices, and then they divide by 50. That's how they're able to plot the SMA 50. So it comes today, they drop the last day of it, then they add today there. So every day it is changing because it's adding a new day, a new closing price, and dropping the last one, all right? Because today becomes the 50th day. So it means there's a day which has been dropped at the back there. Yeah, 50 days from today backwards, okay? So that's why it is always changing. Because today is a 50, it becomes today, when today is included, they have to drop another day to still maintain the 50 days. So as they plot, as it changes, they plot it on the chart. Now it gives us the SMA line, the simple moving average line once it is plotted on our price chart. Then the EMA, it uses a smoothing factor to place a higher weight on recent data points and is regarded as much more efficient. EMA is more responsive to new information relative to SMA. What that means is that when you're calculating the EMA, remember, you don't calculate. You ask just to put the days you want. You want SMA 50, you just change the time to 50, they do the calculation for you. You want SMA 14, you change the time to 14 days, they do the calculation for you. So EMA, it's smoothened. What happens? The most current closing have been given a higher weight. There is some weighting placed on the most current closing prices. So it means it is responsive to new information, right? Because maybe closing price today is way much far higher than 20 days ago, and today's price, because it is high, it has been given a higher weight. So it means the EMA is going to respond, it will be more responsive to the current information because of the weighting placed to the current closing price. Yeah, which now the current closing price has already incorporated the current information. All right, hope you're together. So that's a difference. The EMA, they place some weighting on the most current closing price, as opposed to SMA, where the simple moving average, where all the closing are just added and divided by 50. But for EMA, you add, but the most current are given up. Maybe you can say maybe times 1 point something or times 2 compared to the earlier ones. So it gets a little bit smoothened. All right. So how do we use MA, in general, whether the EMA or SMA, how do we use them? And you're saying MS are used to identify current trend reversals as well as to set up support and resistance. When an MA is heading upwards and the price is above it, the security is uptrend. Here by security can mean the currency pair or the indices or the futures, whatever you're trading, all right? So what we mean by security, because it can be applied in any of those instruments. So when a moving average is heading upwards and the price is above it, the security is uptrend. Conversely, a downward sloping MA with the price below can be used to signal a downtrend. All right. So those who use the indicators like MA, that's what they tell about the downtrend and uptrend. You see, depending on the direction of the MA and where the price is based to or relative to the compared to the MA line. Okay. So when a short-term moving average like 50 MA, 50 MA means 50-day moving average. That's where it has been calculated using the 50 days closing price divided by the 50. All right. So when a short-term MA, e.g. 50 MA, is above a longer-term MA, for example, 200 MA, the trend is up. Okay. So when short-term MA is above the longer-term MA, like 200, then the trend is up. On the other hand, a long-term MA above a short-term MA signals a downward movement in trend. Okay. So moving average trend reversals are formed in two main ways. One, when price moves through moving average, and when it moves through MA crossovers. The other signal of a trend reversal is when one MA crosses through another. For example, a 15-day MA crosses above the 50-day MA. It is a positive sign that the price will start to increase. Okay, so I just plotted an example of two MAs, a 15-day MA, it's a short-term, and a 35 MA. Let me just show you what this is. So the blue one is the 50, is the 35-day MA. Then the red one is the 15-day MA. So we say that when the small one is below the bigger one and the price is below it, it's a downtrend. Yeah, but yes, and the price is above the smaller one, we have an uptrend. Okay, so and this trend is reversed. It tells you the security is reversing, it's gonna go up. All right. So also when the price crosses the MS, it's also a sign of reversal. Like here, the price was above the red one. The red one is the small MA, it's the smaller term, or the 15-day MA. So here the price was above it. Then here it crossed. So those who are using MS, it means somebody would have sold here because it was a sign of reversal, trend reversal, from uptrending to downtrending. Okay, so the price starts coming down, it crosses the short term, then now you sell, you wait to come down. So when it crosses going up, the price crosses here again going up with this strong bullish candlestick. It means it's time to close your sell trade and to enter a bullish trend. Okay, so you can always follow. But remember, sometimes we have also false breakouts. We have false breakouts, just a small break, and then it goes back above it again. So you also have to be careful. When do you really use this as like here, The first one here, we can actually say that we already had a very good pattern. Yeah, on the first crossing from reversing from uptrending to downtrending. We had a kangaroo tail, then the market tried to come down, then it formed a double top. Okay, so if you're combining the price action with the indicators, you can actually now use that to help you to ensure you only take trades which are very clear and they like to give you a good probability to make good profit. So, but if you use the moving average alone, sometimes you can get very false breakouts, which you keep on making some small losses. At the end of the day, actually major losses, and you'll actually see an example in our charts. So you can actually combine price action and MA if you wanted to. Like in this case, we had a kangaroo tail, then we had double top, and then the price crossed the small moving average. So it would have been a position for you to sell, and then you wait. Okay, you come down here, there was a kangaroo tail first, then the market tried crossed again going up, then you close your sell trade, then you buy. After that, you had a very strong bullish strong bullish kangaroo tail. So if you had bought it, it means continue staying the market is going up until again it printed another kangaroo tail, bearish kangaroo tail, now for you to close the buy trade and you sell. All right, so you can still use it, and you can also combine it with your price action. I thought it's good to take you through also indicators. You can actually decide what works for you best, which one are you comfortable with. Okay, but you can see with the MA, you don't have to do so much analysis. It just tells you what to do, but again it can tell you false information. All right, also it responds a bit late to the price, but you can always combine if you find it's doable for you. So we are going to see how they work. Then I had a bigger one, that is the 200 moving average and the 50 moving average, and it behaves the same. Yeah, we said when the smaller one is below the longer term and the price is below it, the trend is downwards until now the price crosses the small MA, and the small MA crosses the bigger or rather longer term MA. Now the price, it means the trend has changed from bearish to bullish. So it is time for you to buy. Okay, if you're following these MAs to give you the signals. If the periods used in the calculations are relatively short, but in case of anything, please ask question. Where you feel you are lost, ask. Don't have to wait to the end. Ask any question. So if the periods used in the calculations are relatively short, like 15-day and 35 days, this could signal a short-term trend reversal. On the other hand, when two MAs with relatively long-term frames cross, so they cross each other like 15 and 200, this is used to suggest a long-term shift. Yeah, and that's why I use the two types. The one is a short-term and a longer term to illustrate that. So MAs are also used to identify support. Sorry, you know, my phone went off, and if you write any question, I will not see when my phone is off. That's why I'm trying to. So who calculates the MAs? Oh yeah, MAs, it's already set up in the system. So what happens? You only change, if you want the longer term, you change the time to 50 and 200. The system is set up to automatically calculate and it plots it for you. You don't have to calculate anything. If you want the short term, that is the 35 and the 15, you change the time to 35 and 15. All right? So trader, you don't do any calculation. Yours is to decide. I want the short term. You change the time to 15 or 35, just the way you want it to be. If you want the longer term, you change the time to 250. You are going to see in the platform how you change that. So that's the only thing you do. You place the indicator on your chart and then you change the days as per the way you want it. And it's going to communicate to you whatever you want. All right? So MA is also used to identify support and resistance levels. So a move through a major MA, e.g. 200, is often used as a signal by technical traders that the trend is reversing. Like in this case, you can see now here we have the 50 MA crossing the 200 MA and the price also crossing at the same point. So which means that it's gonna go up. The trend is changing, right? So I want to share my screen with you. Oh, you got it, Jackie. Great. So I want to share my screen to show you how you place them on your chart and how you change the days so that you get the kind of information, interpret them the way you want to do, and then you make a decision whether to buy, to sell, or to wait. You know why today my phone is misbehaving. It keeps on locking itself, so it makes me it's difficult for me to see what you can see, especially when I'm sharing my screen. I cannot see your comments. So we start with MS. So you come down just below your count. There is where we have accounts, then indicators. So you just click on the plus to expand it. All right, we have the trend indicators, then you have the oscillators and the volume indicators. Okay, so the moving average is under the trend indicators. You come, it's just moving average, you click on it, right click, then you click on attach to chart. Okay, so you can see under the parameters have the period. That is where you change to the days you want. All right, let's say you want to print the smaller ones first, the 15 and the 35. So you change to 15, yeah, and then this is how you also change to what you want. You want the simple moving average, or the exponential, or the linear weighted, or the smoothed one. All right, so we select the simple one. Okay, so you change the period to 15. Then many times it's only simple by default, unless you've already changed previously. Then you click OK. So that is our 15-day moving average. Yeah. You can just use that one alone to say when the price crosses it, I do this. When it crosses this way, I do this. Yeah. You can just use one, or you use two. Yeah. Maybe to strengthen your analysis. So you just come and attach. So we are going to add 35-day moving average. Then we'll change the color so that we can know which one is which. Now we put it to be blue, right? Then you say OK. The blue is not so visible, especially with the font, so I'll change the blue one to something else, set for a different color so that even the guys using font, they can see it. I'll put it to yellow. I'm sure yellow will be visible, yes. So the red one is the shorter term and the smaller one is the slightly longer term based on our analysis. Okay, so we'll also change our time frame to short term, 5 minutes. Okay, so we said when the smaller one is below the bigger one and the price is below it, that's a downtrend there. When the price crosses the smaller one and the smaller MA crosses the bigger MA, it's an uptrend. Okay, and it continues. And where I was saying sometimes you can get a false breakout. So you can see there are some areas with just very small changes. It crosses and before long crosses again, and then it can just bring you confusion. So you must have other ways of confirming it's not a false breakout. All right. Like as you said, maybe price action patterns to confirm to you if this is what is going to happen. Like that one there, that was just a false breakout. Yeah, just as much as crossover, went up, cross down again, only for it to cross up again. All right. So if you want to use indicators, have other confirmation mechanisms to ensure you only take good trades, right? But also here we had something like a double bottom, actually a whammy. So the moment it crossed going up, maybe you'd have bought based on the smaller one has crossed the bigger one. Price also crossed both of them. At the same time, to your left, you have a whammy pattern. You're like, now it confirms it's time to buy. Yeah. You can check it went up. How many points? Close to, from the crossing, this is 1342 up to 1367, that's around 25 points within a very short, because this is a 5-minute chart. So you can still use this the indicator if you're comfortable, but have other confirmation mechanisms to be able to filter and take only good trades. Okay. So this is the small one. I will go for the bigger one and see. You don't even have to delete, you're just going to change. Sorry, I should have deleted the other one. I'm just going to return it. So now we'll put this one to be 50. In the longer term, the small will be 50. And the yellow one will be 200. So again, it's also good to use one with bigger time frames. If you use the longer term, use a little bit bigger time frames. In this case, I'll use H1 so that they make sense. So you can see when the price was below it, there's a lot of noise. So it's crossing up and down, all right? Also in M5. So, but the moment the price crossed both of them, and the red one, which is the 50 MA, crossed the 200 MA, now there's some continued move up. Because we said when the price is, like on the left, when the price is below the smaller MA, the smaller MA is the bigger one, we are on a downtrend, sorry. So when they cross the price above the small MA, and the small MA is above the bigger MA, we have an uptrend, okay? So, but the bigger ones are better with the long-term traders, so you can actually hold for some time. So you're better using the shorter time frames, if you want to use the MS, use the short-term MS. That is the 35 and 15 or 14 and 26. You can always change to whatever you're comfortable with. Okay, so if you're using the MS and you're trading short-term, use also the short-term MS for your good analysis, yeah? Like when you're on 5 minutes and you're using the 15 and 30, they make a little bit more sense, and you go to the long term. Because the long terms, you also have to hold your trades for long term for the MS to make sense to you, so if you're using them. So basically, that's the MS. We can also change them to EMA, that is the exponential, and see what happens. From simple to exponential. It's not a big change, but there's a change. There's actually a change. There is a change. They get smoothened, all right? And also the response is also good. Like this have come a little bit down, mean they responded to price in good time. So that's it with the MS, unless there's any question. If there's any question, we go back and study now another indicator. We look at another indicator. But you can always drop a question anytime. If you are lost, please tell me you are lost. We clarify everything so that you get it right. Ask any question. Don't be lost and be left behind alone. After MS, we look at MACD. Moving average, convergence, divergence. In short, just call it MACD. Sorry. So also, as you read that analysis, you just come across something like the MACD. It's behaving like this. MACD is crossed this way. So you just ask, what is this MACD? It's also good to have some information about it, just in case you come across such analysis, they will make sense to you. Also, in case you want us to incorporate it in your strategy. So this indicator is comprised of two exponential MS, yeah, which is used to measure the momentum in a security. The MACD is simply the difference between these two MS plotted against a center line. The center line is the point at which the two MS are equal. So, along with the MACD and the center line, an EMA of the MACD itself is plotted on the chart. So basically we have like 3 MS and a center line, all right? But all this story should not really worry you. You don't have to know all this, just know how MACD works. But just good to know the story behind how it works. But you don't have to know how to calculate this one, how to make the differences, how to plot which line. No, the system plots them for you, all right? This just to make you understand how the MACD is derived, how it gets to become what it is when you put it on your chart. So the idea behind this momentum indicator is to measure short-term momentum compared to longer-term momentum to help signal the trader. So when the MACD is positive, it signals that the short-term MA is above the longer-term MA and suggests an upward momentum. Okay? So when it is positive, it means it's above the zero line. We're going to see that. And when MACD is negative, which means it's below the zero line, the center line, then the shorter term is below the longer term and suggests downward momentum. You can see it's still, we interpret it the same way we were interpreting the SMA and EMA. The smaller one is below is a downtrend. When the smaller one is above is an uptrend. So the same case with the MACD. So when the MACD crosses over the center line, it signals a crossing in the MS, all right? Remember we said it's drawn by, you have two MS and the center line is arrived by getting a difference between the two MS. So it means when they are crossing, they are equal and they are crossing the zero line, because if they are equal, it means, let's say they are equal and they are 2. And we draw that one by getting a difference of the 2, because 2 minus 2 is 0. So when they are crossing at the zero line, they are equal because at that moment their difference is 0, and that line is the center line is the zero line. That's the interpretation of that kind of a sentence. So the most common MS values used in the calculation are the 26-day and the 12-day EMA. The signal line is commonly created by using a 9-day EMA of the MACD values. This is just for information. You don't even have to calculate all this. It's just for your information. Yeah. So these values can be adjusted to meet the needs of the trader and the security. So for more volatile securities, shorter term averages are used, while less volatile securities should have longer term averages. In MACD, you also have an histogram, and you're saying the histogram is plotted on the center line and represented by bars. So each bar is the difference between the MACD and the signal line, or in most cases, the 9-day EMA. The higher the bars are in either direction, the more momentum behind the direction in which the bars point. So one of the most common buy signal is generated when the MACD crosses above the zero line, while sell signal often occur when the MACD crosses below the signal line. So we're going to see how the MACD looks like. So that's our MACD. That is just whatever those white mountains you're seeing. Yeah? So I've shown you this, that is the histogram and the zero line. Yeah? So you can see there's a lot of crossing. I've enlarged until I cannot see the zero line properly. Okay. So you can see there's a lot of crossing. Yeah? So we are saying when it crosses going up, it's time to buy. It crosses going down, it's time to sell. And the size of the histogram, you know, the bars, the white bars, it indicates to you the momentum, the strength of the guys in charge. All right. So the longer they are, the stronger the momentum. All right. So you can see when it crossed over, it was time to buy. It went up, it formed a mountain, it came down. So the crossing is an indication for you to buy. If it's going up, you buy. If it's going down, you sell. All right. So I'll also take you now to the platform. We draw a MACD and then we try to see how we can trade it. Hope you guys are following. I'm not losing you with all this many tough language of MACDs and many EMAs crossing each other. You're following, great. You've been terrible. So now we look for the MACD. MACD is among the oscillators. So we just the way we did the rest, you click on it, right click, then say attach to chart window. All right. So here we are not going to change anything. What we have is just what we discussed there. There is the first or the short-term EMA is 12-day EMA. Whatever they call the slow EMA is the long-term EMA is the 6-day EMA, and then the MACD SMA. Yeah, it is derived from the two EMS. It's 9. It's the 9 whatever we have. That line is the 9 now. So then you apply to close. You don't change anything. The parameters remain the way they are. You just say okay, unless you're dealing with a less volatile instrument where you can now make it a longer term. You can change the fast to be like 50, slow to be 200, and then now the MACD SMA will maybe come automatically. Okay, so we say okay. So we can see when it crosses, the market is going up. When it comes down, it was going down, the market is coming down. So also the momentum. Remember what it does about the momentum in our analysis. You can look at that. It's very steep momentum, and also the MACD, when you check the MACD, is also very steep. So it can also help you, guide you in knowing whether the momentum is slowing down or it is getting stronger and stronger. All right? Like if you have two hills for each other, you can always tell whether the momentum is weakening or is strengthening, depending on how steep the hill is, or that how slanting, how steep, and how leveled it is. The other thing you see about MACD, sometimes it can actually form some pattern which can also give you a signal. Yeah, like here, when you draw a line here on the two hills, a lower one and a very flatter hill, it sort of forms a double bottom, right? Also, when you come to your chart, you might find the same kind of a pattern in your chart. Okay. So once in a while, it can also give you some patterns to give you clues of what the market is likely to do. Yeah? But we use the market when it crosses coming down, it tells you it's time to sell. So in this case, you should have sold where? You should have sold somewhere here. You have sold there when it cross coming down. So while we are saying the indicators are sluggish, how do you determine if the momentum of the market is weakening? It is just depending on remember the bars, the histogram tells us the momentum. The taller, the bigger they are, the stronger the momentum. But when they are a little flat, it tells the momentum is not so strong. If they are too flat, okay? But as like you can see this, let me draw these two lines. You can see this one. Look at that momentum there, and also look on our price chart. They are very sharp. They are very steep. In other words, they are very steep. Okay. Then look at this other momentum here. This one is a little bit more slanting. Okay. Also, you look at our price chart. It's a little bit more leveled, or rather more leveled compared to the first one. So when the hill is very steep, it tells you the momentum is also very strong. If it's a little bit leveled, it means momentum is not so strong. The histogram tells us about the momentum. Okay, so that's how you interpret it, Jackie, as per your question. Hope I answered you correctly. So, well, I will try to explain why we were saying the indicators are sluggish. If you are to follow whatever the MACD is telling us, it means that this would have sold at the red line. But if we are using our normal price action analysis, let's say we had, sorry, there's something I cannot see this side. So I'll draw it just from where I can actually see. Or I go to H4, I draw at H4, and I go back. Yeah, I draw my Then we remove everything we analyze the H4 because it is a little bit clearer under H4. So we say, according to MACD, when it crosses going down, you sell. If it crosses up, you buy. So we are saying, in this case, you should have sold here. Yes, we have put that line. If we found the price around here, so we try to cross, then we sell. But if we are using price action, I would have drawn my Fibonacci, then wait for the price at 76. So I would have sold where? I would have sold at this point. I would have sold here. The moment it touches the Fibonacci 76 and gives me a signal. So that's what I meant when I said the indicators are sluggish. We have to wait for the crossing. If you're used to MACD, you wait for it to cross, because we sell and buy at the crossing. Because you can enter a trade only to realize the next one has weak. Yeah, that's so strange to see some of the disadvantages of indicators. Some are false breakout. You can just cross, and after a short, very small movement, it crosses back again. All right. So there are those false breakouts. All right. And I'm going to show you one of the disadvantages of an indicator compared to our price action strategies. Yeah. So if you're using this market, you're using H4, would have sold at this big line here, the vertical line. Let me make it thicker for you to see clearly. Because that is the time the MACD crossed coming down. But if we are using price action, we are done our analysis and we saw the price, let it hit 76, then it gives us a signal. We would have sold that where my red arrow is. So what is the difference? We would have sold at, luckily pick the low price of 1482. If I'm using my price action, 1482, and the other person sold at 1411. That's a 70 pips difference. That's why it gives you a signal too late, as opposed to someone using the price action and using the signals of a price action. That's what I meant by they lag behind. They respond too late to the price because they follow the price, as opposed to when you move ahead of the price, then you make your analysis. But I still felt it's good for you to understand the indicators, to appreciate also what those who use indicators also what they see and how they analyze them. But other people, they can also try to fine-tune the indicators to make them, now they use them in a different interpretation. Maybe they don't use the crossing to make decisions. They also look at other opportunities still using the same indicator, all right? So you find they still use the same indicator, but they interpret in a different way. As you see, there are so many ways of trading Forex. So you can see this is the same indicator to communicate to you a different language. But ideally, the MACD, you only use it if it is crossing going down, you sell. Crossing going up, you buy, all right? So this is one of the examples of where we said it lags behind. The indicators lag behind. They respond too late, so they make you leave a lot of money in the market. Like here, if I entered at my price action, we saw I would have entered at 1482, and yet you're using MACD, you enter at, when it crosses at 1411, so me already have my 70 pips profit, as when you yourself, you already now you're entering the market. So that's the difference. the 15th Feb 1600 to 20th Feb, what does the gap mean? 15th Feb. Actually, there is no gap. There are very small bars, extremely small bars. Yeah. And I can tell you that when you place your cursor, it tells you, and the value was negative 0.00002. There was a small bar but facing down. There's no gap. It's just that the movement is so small to really give you a significant bar size. That's what it means, Marianne. So Marianne is in between here. Sorry. That is 15 there, is it? Yeah, around there. Let me make the bar a little bit thin so that we can have a clear between that and this other date here. Actually, it's at 19 there. So there is no gap. There are very small bars there, but they are not so. That is not so strong enough. The momentum is not so strong enough to give us a longer bar, but the bars are still there. When you place your cursor, it gives you the size of the, like the current bar, the size is 1257. So in between those days where Marianne sees a gap, one of them is negative 0.00062. That's the bar size or the histogram size. The other one is 0.003. So there are no bars, Marianne. There is no gap. They are there, but they are very small. Great, you got it. I did. But there are also the momentum is so weak, and it's like there is no direction. Yeah, it is very weak. That's what those small bars mean, or that we can interpret them. Great. So that's it. That's it about MACD. We go and look at another indicator. And the other one is we're going to look at relative strength index, or RSI. So RSI helps to signal overbought and oversold conditions in a security. Relative strength index. It helps to signal overbought and oversold conditions in a security. The indicator is plotted in a range between 0 and 100. So a reading above 70 is used to suggest that a security is overbought, while a reading below 30 is used to suggest that it is oversold. So this indicator helps traders to identify whether a security's price has been unreasonably pushed to current levels and whether a reversal may be on the way, right? So this indicator just helps us to know whether that particular pair has been oversold or overbought, depending on where it is at the time of our analysis, okay? So we look at a chart here. You can see that. So you can see the blue line. The blue line is our RSI. So again, you just place it the same way we placed the other indicators. And when you see at the end, you can see there is 100, 70, 30, and 0 to the extreme right. There's a scale there below the price where the prices are. We have 170. So that is the range of our RSI. So if RSI crosses 70 going up, it means the pair has been overbought. Yeah, it has been overbought, so it is likely to reverse. Okay, so when it is overbought now, the sellers start coming in and they start pushing it down. If it crosses 30 going down, it means the pair has been oversold. All right, it has been pushed too far. So the bulls need to come in and push it back up. Okay, so and you're seeing the standard calculations for RSI uses 14 trading days as the basis, which can be adjusted to meet the needs of the user. If the trading period is adjusted to use fewer days, the RSI will be volatile and will be used for shorter term trades. Okay, so you see we can always change the parameters to match the instruments you're trading. Okay, so that's how you interpret it. If it crosses 70, and you'll see that in many analyses where they say the RSI is over 70, so the instrument has been overbought, we expect it to start coming down. Or it crosses 30 going down, we say it has been oversold, so we need the bulls are coming in to start pushing it up. All right, but actually you can also use this in our price action. You can actually combine it, yeah, because if it is oversold, let's say it has been overbought, it's over 70, then at that level you can actually try to look for any reversal patterns, a double top, a head and shoulder. Yeah, you can try to see if you can see something like that. Or if it's in your normal analysis using the Fibonacci tools, and you had marked your area of interest to be maybe 61.8 Fibonacci ratio retracement, and you see now the RSI crosses the 70 when the price has reached 60, and you see a signal. So it's almost a confirmation that actually the bears are coming in to push it down. So you can still combine it, although don't rely on it so much, just like almost another confirmation that actually your analysis is right. Although it may still not be at 70, but it can also be add some info to your trading. You can still use it. Yeah, so it can maybe give you some confirmation about your analysis if you so wish. Personally, I don't use it, but I'm just there's other ways you can actually use it to confirm your decisions, yeah, to confirm your analysis, or rather added some more strength in what you've come up with. You can see like the first crossing to 70, it was so high, it came down, try to hit 30 at the very bottom, jumps up. You can see anytime it hits 30, yeah, there's a lot of struggle. The bulls push it back up. Yeah, again, we say this market is operated by human beings like you and me, and we know when it's over 70, it's overbought. So the bulls stop buying and the bears start coming to push it back down. When it's below 30, everybody knows it has been oversold if they use the indicators. So the bears will stay away because it may not push down any further. So at that moment, when the bears are giving up, the bulls come back and push it back up, right? And that's how it works. So again, I take you to a platform. We just see an example of the same. So you can still combine some of the indicators. If you feel some are useful, you can still combine them with your price action analysis and see if they can strengthen your strategy or your analysis to see things the way you like to see them appear. Hope you can all see a test. So now we're back to our chart, and you're looking for relative strength index. It's also one of them. It's under the oscillators. Just click on it. It gets highlighted. Right click, then click attach to a chart. Okay. Again, we use the period of 14 days. Is already marked there. So we change nothing on our parameters. We just say okay, and there you go. Okay, you can see it tried to cross the 70 line. Yeah. So you see when it gets to 70, you can see that the bears start coming in and the bulls are struggling. There's some struggle there. We can still go to 5-minute chart and just find the behavior is just the same. It has crossed 70 slightly, and now the bears came in, they pushed it back down. All right. So if you wish, you can say combine your analysis to see if you can actually strengthen your whatever you see on your chart. Yeah. But basically, that's how you use the RSI. When it's above 70, it means it has been overbought. And so we expect the bears to come in and push it back down. If it's below 30, Around here below 30, it means that the security has been oversold. So the bulls there start getting out of the market, or rather start shying away from selling, and the bulls come in and push the market back up. That is RSI. Actually, before we move from here, the same way it works with the stochastic oscillator. Yeah, so I will remove this and put the stochastic oscillator. We are going to see the notes on the other side, but we can just look at how it operates. So stochastic oscillator, you just click on it and attach to chart. The days are the same. The period is still also used 14-day period. Now this one, still the range is 0 to 100, but the overbought position occurs when it reaches 80, and oversold position is arrived at or reached when it goes below 20. So the difference between stochastic, it uses the range of 20 to 8 to determine oversold and overbought positions. That's the difference between the stochastic and RSI. All right. So as you can see, okay, there are other differences which are deeper in how they are constructed, but this is just what we can see as the traders. There's a lot also in between which brings the difference between the two. All right. So for stochastic oscillator, when it crosses 80, it means the security has been overbought. So the bulls need to come in and push it back down. When it crosses 80, it has been oversold. The bulls come in and push it up. Sorry, the other one, I think my sentence was not correct. So if it crosses 80 going up, it has overbought. Bears need to come in and push it back down. If it crosses 20 going down, it has been oversold. So the bulls need to come in and push it back up. All right. That's how the stochastic oscillator works. Okay, so I think with that we need to go back and see the other oscillator and see what it tells us. So stochastic oscillator, the stochastic oscillator is plotted within a range of 0 and 100 and signals overbought conditions above 80 and oversold conditions below 20. The stochastic oscillator generally uses the past 14 trading periods in its calculation, but can be adjusted. Okay, so we've just seen that. This is just what we've seen in our chart. As you can see, so range is 0 to 100, over 80 overbought needs to come down, below 20 oversold needs to come in. All right, also if you're using stochastic oscillator to make your decisions, so basically once it crossed 80 going up, you wait for it. When it is crossing 80 coming down, you sell. Okay, so it comes down. If it crosses 20 and goes below 20, you wait for it. Once it now starts going up, at the point it is crossing 20 going up, you buy. That's how traders use the stochastic oscillator. So if it has gone past 80, it's above 80, you wait for it to turn. When it is coming down, it crosses 80 line going down, you sell at the crossing of 80. If it is below 20, meaning the security has been oversold, you wait for it to turn. When it is crossing 20 going up, you buy. So that's how you can use the stochastic oscillator to make your decisions. Then you go to average directional index, the ADX. And the ADX measures the strength of a trend but not direction. The ADX is a combination of two price movement measures. One, the opposite directional indicator, which is plus D1, and the negative directional indicator, negative D1. So the plus D1 measures the strength of the upward trend, while the negative D1 measures the strength of the downward trend. So the positive measures the upward, the negative measures the downward trend. So these two measures are also plotted along the ADX line. So measured on a scale between 0 and 100, so any readings below 20 signals a weak trend, while readings above 40 signals strong trend. Is a question, You're liking them. They're making your work easier. Okay, please try them. That's I thought I should actually share. Oh, Marianne, you've made my day. You're liking them. I'm happy because they are very easy. Just read and you make your decision. But again, remember we said there are force breakers. So be careful. They don't just tell you to buy only for them to go the opposite direction. I like that. That's a good one. It's good to just see what you're enjoying in our teaching. So please try them. That's why we said, see how you can also use them to your advantage. We say there are so many strategies in Forex. You can see you can actually use to your advantage. Maybe whatever works for me may not work for you. What works for the other person may not work for me. So you see how you can use the information we have to the best of your best to make more profit. Thank you, Marianne. Try them and always give us. Remember, we are saying we are going to do trading, and then you share your results in the main chat. You tell us I ended because of this reason. This is what I came up with, or rather, which is what I made. Whether it's a loss or profit, you need to see all those feedback. So we are on the average directional index. Great. So we are saying the plus D1 measures the strength of the upward trend, while the minus D1 measures the strength of the downward trend. These two measures are also plotted along the ADX line, measured on a scale between 0 and 100. So readings below 20 signals a weak trend, while readings above 40 signals strong trend. So we are going to see a chart. So this is ADX. The indicator below there is so many. All those many lines have some interpreter, but it's not necessary for us. We just want to see how to interpret the readings of the ADX. As you can see, just next to the white line, we have ADX 14. 14 is the 14 days ADX, means calculated using the 14-day period. Then we have, that one then we can look at to plus D1. Plus D1 is 12.2182. Remember we said, if the reading is below 20, it means the trend is weak. If the reading is above 40, the trend is strong, all right? So in this case, and when you look at the price chart, there's a struggle there. The price just like in a range. So you can see none of them is really strong. Not upward trend, not the downward trend. But the upward trend is very weak. It's way below 20. It's at 12.21. No wonder you can see the bulls are giving up. The bears are really coming in because the upward trend is very weak. It's below 20. But the downward, which is negative D1, is 23.57. Although a stronger one should be 40 and above, but at least it's above 23. So it's not so weak. So the bears are trying to come in and take control. That is the ADX. That's why we use the ADX. Okay. So I'll take you to the platform and then we see. So we come to ADX. Click on it, right click, attach to chart. Period 14, so we change nothing on the parameters. So just we click OK. It comes to the chart. So when you look at the price where it is there, we have the plus D1 is 23.094. Minus D1 is 10. Meaning the upward trend is a little bit strong. Just being 23. But although it's not so strong, remember it's only strong. We take it to be strong if it's 40. But currently is the plus D1 is 23. But at least it's not so weak because it's not below 20. But when you look at minus D1 is 10.61. So it's very weak, the downward trend. So it means the market is uptrending for more opportunities to buy. Okay, so that's it about the ADX. We just look at the interpretation of the D1, the readings, the plus D1, the minus D1 to tell which trend is stronger. I said the upward or the downward. So to tell you whether to buy or to sell. Okay, so it's just straightforward. I don't need to do much. Before I go back, I just want to take us through the Bollinger Bands, and I will go and read the notes. Well, we can just go back there. We look at the notes very fast, and you might draw them and see what they are when you have the knowledge of what they are from the notes. So the last one is Bollinger Bands. And you say this tool adds and subtracts the standard deviation of price data. So this tool adds and subtracts the standard deviation of the price data changes over a period from the average closing price over that same period from same time frame to create trading bands. Okay, so all that one, you don't have to really know what that's what I'm just telling us how they are constructed. So Bollinger Bands can be used to time entry to trades. So a trader might consider to take a short position when the price reaches the upper band and take a long position when the price reaches the lower band. Bollinger Band has three bands. There is the upper band, the middle band, and the lower band. So we are saying you can use the outer bands, that is the upper band, to sell. When the price hits the upper band, you sell. When the price hits the lower band, you buy. Okay. So a trader holding a long position might consider taking some profit if the price reaches the upper band. And a trader holding a short position might consider taking some profit if the price reaches the lower band. So you can also use the bands for your take profit decisions. And the middle band always acts as potential support or resistance. It's like a breakout when candle closes above or below the middle band. So this is the Bollinger Band. So when you just place it, it produces these three lines. You have the upper band, the middle band, and the lower band. So you are saying when the price hits the upper band, you can decide to sell. Yeah. It hits the lower band, you decide to buy. So that's how you signals the buy and sell signals. But saying when it crosses the middle line, going whichever direction, when the candle closes below or above the middle band, it means there is a breakout in the direction in which the candle has closed. Okay, so if it was coming up and the candle closed below the middle band, it means there's a breakout going down. If you had sold, you can continue holding your position and only close once it hits the lower band. So the only thing, but I think that I can mention in the price chart, we go to the price chart, we look at the Bollinger Bands, then we can interpret further. You can see that so under trend indicators, we have Bollinger Band just below the ADX. Click on it. Just wait for my screen to pop up on my to be sure we are all there. Good. So you click on Bollinger Bands, right click, attach to chart. You can always change the color if you want. Yeah, but we can have it red. Also, as I mentioned, some people also, they try to use the same, they can actually redefine those indicators to make them to be able to interpret the market in a different way. All right. You find so many strategies. There's another actually I'll try to use some time last year where someone was combining a daily Bollinger Bands candles and a weekly ones, and from all that to make a decision. So people are able to actually try to modify them. You have to communicate to them the kind of message they want them to give a clearer message. Okay. So we are saying with the Bollinger Bands, there is the upper band, the middle, and the bottom. So if you're using these linker bands to trade, once it hits the upper band, you're saying you sell. All right. When it hits the lower band, you're saying you buy. Okay. And when a candle closes below or above, because the middle one is like a line of resistance and support at the same time. If the price coming from up, it means the middle band is a support line. So, but if it crosses and the candle closes below the middle band, it means now there's a breakout and the market like to go down further. But if the market is coming from down, coming up, it means the middle band is a resistance. But if a candle breaks through and closes, it has to not just a wick, but the candle closes above the middle band, it means the market has broken out and like to go up until it touches the upper band. All right. So if you're holding a buy position and it closes above the middle band, you can continue holding your position because it tells you the market like to continue going up. Okay. So the only challenge with this, we are saying you sell when the upper band is hit. But as you can see, sometimes the candles can actually continue hitting and walk along the upper band. So you need to know, so at what point are you sure it's going to come down? Now imagine if you sold here because it hit and it came down, yeah? Only for it to bounce back again. And then it continued trading along the upper band. So how will it, at what point do you decide to buy or to sell? So if you want to use the upper the Bollinger bands, you can just decide, well, yeah, I will sell when it hits the upper band, but I must get another confirmation, either a pattern or the kangaroo tail or something else. Okay, so you can always maybe incorporate it with other patterns to decide. So I will not just wait for it to hit the upper band to sell, but once it hits, I will wait for another confirmation, either a double top, head and shoulder, or a kangaroo tail, or any other pattern, which will signal me now, yeah, it's time to sell. The market it's going to change to go down. The same case with when it hits the lower band, which tells us we're supposed to buy. So you can wait for another confirmation signal, either a pattern to be formed, talk of kangaroo tail, double bottom, yeah, or a inverse head and shoulder. So to confirm, yes, this market has hit the bottom, it's actually reversing and it's going up. Okay. So that's about the Bollinger band. So you can always try it out to see if it can work out for you. But you can see something the market can move, the price can move along the band. So you have to be sure at what point is it telling you to buy, if it's working along moving along the lower band. Or at what point is you to sell, if the price is along the upper band. Okay. So after about the common indicators, as you can see, there are so many of them, quite many. When this is Ichimoku Kingo here, you know, it sounds, I don't know, like you're talking Chinese. I've also tried to use before. There are so many of them. So, but I only shared with some of the commonly used, which you'll find they're used in some analysis, and you need to understand what they mean by that. Okay. So at your own time, you can see the rest if you want to do that. But of course, you know, when you look at them, they may not tell you much. You have to research on them. If you want to use them, you have to research, find out. So how does it speak to me? How do I use it? Yeah, because just putting it there by itself, that may not tell you much. You have to know. So if there are readings from that indicators, how to interpret those readings? Okay. So you can see, try the ones we've discussed and see how they work out for you. Also see how you can actually complete the price action we've discussed. Okay. And then you'll see something called expert advisors. Yeah, this one enables you. Sometimes some people are able to come up with their own indicators and they code them. Once they code them, you can actually now attach them to your charts. So those ones, bring them under expert advisors. You can hear somebody say, I've come up with a very nice EA. They just call them in short EAs. Yeah, so it means they are indicators are built outside MT4, right? There are guys who are so smart, they are mathematicians, they're able to come up with their own indicators, they're working well, so they actually sell those indicators. So when you want to incorporate to your chart, to your MT4 platform, you put them under expert advisor. So these are, you just import them from out there, you bring them to your chart. So they are called EAs, expert advices. Great, that's it about the indicators I thought we should cover today. So as you can see, there are many, but we just pick the key ones, which are commonly used in analysis and which you feel you can actually use them and they make sense to you. Any question before we end the class for today? Any question? Any query, any concern? We are good. Silence means we are good. So please try them. Try to see if they can make sense to you. If you can incorporate them in your price action analysis, or you need any clarification, always ask. Then you're going to help you out. So tomorrow we are going to cover the psychology and risk management. Psychology of trading and risk management. Sorry, trading psychology and risk management. We'll also cover what we had mentioned in our price chart, in our course outline about copy trading. To just take you through how you can also copy other traders. But again, this will only work if you are with, because the investors whose data I analyze, they are people who trade with FXTM. They are FXTM traders who have allowed their strategies to be used, but they don't really use them per se. You invest with them, all right? And this only works if you're trading with FXTM. So if you have FXTM as your broker, then this will flow well for you as you do the topic for copy trading. There are guys I analyze their data, rest on their risk indicators, profitability indicators, and then you're able to decide which one can I invest with. Okay, so as I learn how to trade, as I practice, I can still invest with a profitable investor, or rather profitable trader, to continue trading for me even as I learn and to see if I can earn something. Okay, so that will cover tomorrow, and I take you through some of the analysis I've been doing, and now we make the decision based on their risk. If you're a risk taker, which one you can actually select. If you're risk averse, which one you can actually go for. All right, so I take you through that, but only makes sense to you if you're with FXTM. So if you still want us to do that topic with you, you can actually ensure you open an account with FXTM. I've seen some of you have. I'm not sure how many have not yet. Please, if you have, do open an account with FXTM. You never know when you might need to invest with those guys, because you need as little as $100, which is equivalent of 10,000 Kenya shillings to start an investment account. So you can actually, it's a good thing to just invest with them. Where there's a risk take, it's a risk you're taking. They can still lose your money. They're not really at expert. Returns are not guaranteed. But again, we said in Forex, we take a risk. Okay, so you're able to analyze and see, can I risk with? Put little money with them. They continue trading for me as I continue learning Forex and earn something from Forex as I continue to learn. So we are going to cover that tomorrow after we do trading psychology and risk management. Great. So that's it for today. If you don't have any question, I wish you a good night. See you